Number 10. BT. 55,000 jobs by 2030. That was the number BT put on the table when then CEO Philip Jansen announced the plan back in 2023. When Alison Kirkby took over in 2024, she confirmed the same target. The share price barely moved. The market had already accepted it. BT employs around 130,000 people across the UK today. By the end of the decade, that falls to somewhere between 75,000 and 90,000. More than 40% of the workforce gone. The justification keeps changing. The outcome doesn't. First, it was the completion of the fiber rollout. Then it was network upgrades that supposedly need less maintenance. Now it's artificial intelligence and automation. Around 10,000 of those roles are being replaced by AI, according to BT's own statements. Customer service chatbots handling calls that used to go to people. Automated planning systems, removing the need for experienced engineers. 16,000 jobs have already gone in the past 2 years. Another 2,000 were announced in January 2026. And there are still years of cuts ahead. Most of the reductions so far have been voluntary, which sounds gentler, until the reality sets in. Thousands of families losing income, communities losing skilled employment. Engineers made redundant once infrastructure is built, even though maintenance and customer issues remain. The union response has been remarkably quiet. Number 9. Sainsbury's. 3,000 jobs disappearing after the biggest Christmas in the company's history. Record sales. 7 consecutive quarters of growth. Profits expected to exceed £1 billion in 2026. And yet, cuts. The announcement landed in late January. All 61 remaining in-store cafes permanently closed. Patisserie counters gone. Hot food counters eliminated. 20% of senior management roles at head office axed. CEO Simon Roberts calls it accelerating the next level strategy, making the business more efficient and effective. The cost environment is challenging, he says. Employer national insurance contributions rising by £140 million in April. But this is still a company making over £500 million in profit. A company that raised prices for customers, paid bonuses, rewarded shareholders. The cafe closures make the priorities clear. Sainsbury's says most loyal shoppers don't use the cafes anyway. That might be true statistically, but those cafes employed real people. They created community spaces. They offered work to people who didn't fit easily into other roles. Now those spaces are being handed to third-party operators run by the Beauperrin Group, the poultry empire behind chicken sold in the same supermarkets. Different employer, different contracts. Same space, less money staying inside Sainsbury's employment structure. The 3,000 job losses will roll out over the coming months. 20% senior managers with severance packages. 80% store staff. People on counters. Bakers who've been there for years. The union calls it corporate greed. Sainsbury's calls it transformation. Number 8. Tesco. 400 jobs cut at Britain's largest supermarket. 27% market share. Its biggest Christmas ever. The changes sound technical. Simplified bakery models. Updated management structures in Tesco Mobile. Head office roles removed. 400 doesn't sound huge compared to BT, but it's part of a pattern. Tesco, Sainsbury's, Morrisons, all cutting at the same time. All citing the same challenging cost environment. All doing it immediately after record trading periods. CEO Matthew Barnes says these are difficult decisions affecting colleagues, but necessary to invest in what matters most to customers. Invest in what exactly? Lower prices through job cuts. Better service through fewer staff. The logic doesn't survive scrutiny. Number 7. Lloyds Banking Group. 1,600 jobs. But not through traditional redundancy. Lloyds closed 136 branches between May 2025 and March 2026. That part is already happening. The real story is performance management. Lloyds employs 63,000 people. All are being assessed. The bottom 5%, around 3,000 employees, face potential dismissal if they fail improvement plans. Roughly half are expected to lose their jobs. Not for misconduct, not for redundancy. For being ranked in the bottom 5%, CEO Charlie Nunn calls it building a high-performance culture, aligning with industry norms. Turnover is currently 5%. Historically, it was 15%. People aren't leaving fast enough on their own, so the bank is pushing them out. Branch closures tell another story. Transactions have fallen 48% over 5 years. 10 million fewer visits in 2024 compared to the year before. Everyone banks on phones now, according to Lloyd's. Except 8% of customers still rely entirely on branches. Older people, those without smartphones, those in areas with poor connectivity, but that 8% doesn't justify the property costs anymore. Number 6, Barclays. A quiet investment bank purge. 5,000 jobs cut last year. Another 200, at least in 2026. Technology roles supporting trading teams. Executive assistants offshored to India. In January alone, 51 developers were let go. Credit teams, equities, fixed income, foreign exchange. Then came the return to office mandate. Directors and managing directors required to be in 3 days a week from May. Sources say it quietly forced out staff who relocated during the pandemic. Then the cuts followed. Barclays committed to cutting £2 billion in costs by 2026. 700 million of that from the investment bank. They're 500 million in, and costs are still rising due to severance and inflation. The sustainable and impact banking unit was hit especially hard. A team built in 2019 to support environmental and social projects expanded in the US last year. This year in London, gutted. ESG skepticism meets cost-cutting. Jobs vanish. Number 5. Royal Mail. Thousands of jobs disappearing as letters give way to parcels. 10,000 roles were cut between 2023 and 2024. Another 7,000 are coming through natural wastage. 1,000 direct job losses tied to universal service obligation reform. The shift is structural. Letter volumes falling, parcels rising, automation replacing sorting roles. 2 new super hubs built to run with minimal staffing. Royal Mail was sold to Czech billionaire Daniel Kretinsky's EP Group. Workers accepted a deal in 2025 that included pay rises and mass restructuring. Union leaders call it facing the reality of privatization. That reality looks like this: fewer delivery days, 3 or 4 instead of 6 in trial areas, longer routes, heavier loads, technology tracking every pause, a public service transformed into a profit extraction machine. Number 4. Rolls-Royce. 2,500 jobs cut. Despite £2.4 billion in profit. CEO Tufan Ergin called the company a burning platform when he arrived. Then profits more than doubled. Middle management and engineering roles cut. Savings delivered. Share price up 120%. Jobs lost in Derby, Bristol, Lancashire, Glasgow. Large engine orders at their highest since 2007. Flying hours nearly back to pre-pandemic levels. The business is strong, so jobs go anyway, because margins matter more. Number 3. Vodafone. 11,000 global cuts, with heavy UK impact. CEO Margherita Della Valle said performance wasn't good enough. The target is €1 billion in savings by 2026. Hundreds of UK roles already gone. Then came the Vodafone 3 merger approved in December 2025. Up to 1,600 additional UK jobs now at risk. Network development roles offshored to India. Contractors leaving late 2025. Permanent staff by January 2026. The merger promised growth. Instead, it delivered layoffs. Number 2. Shell. 20% of exploration and development staff cut. Despite $6.2 billion in profit, CEO Wael Sawan pledged to be ruthless. $2 to $3 billion in savings. Jobs eliminated across divisions. No full numbers disclosed. Refineries sold. Renewables scaled back. High-margin fossil fuels prioritized. People who built the business shown the door. Number 1. Unilever. 6,000 jobs gone globally, with 6,000 in the UK alone. 1/3 of European office roles eliminated. 3,200 positions gone across London and Europe, driven by an €800 million productivity program. Pressure from activist investor Nelson Peltz. Employees angry. Management tone is cold. Household brands built by workers, discarded for margins. This isn't financial distress. These companies are profitable. Many are growing. The cuts are about something else. Shareholder returns, automation, quarterly results, rising national insurance and wages are real pressures, but they're absorbed by cutting people, not executive pay. Technology accelerates everything. AI replaces service roles. Systems replace humans, and the market rewards it. That's the real shift. This isn't a crisis. It's the new normal. Profitable companies choosing to employ fewer people and being rewarded for it. And that should worry everyone.